First idea here, Converge Technology Solutions. It's an IT provider, and they are going through a strategic review.
Yes, I've talked about this stock quite a bit on the show, so I'm not going to talk about the base business. The exciting part right now is that on November 23rd, they announced that they formed a special committee. They had gotten some expressions of interest from outside parties who wanted to acquire the company. They're going through that process now. The way I'm looking at this trade is as follows. Stock sitting around $6, maybe slightly underneath. If it gets sold, the range is probably $8 to $10, maybe slightly higher. So in my scenario analysis, I'm using $9, which would give you 50% upside from these levels. If the company is not sold, you'd probably see some of the shareholders who own it just because of the deal head for the exits. You'd probably see it trade down to about 5, maybe slightly lower as the shareholder base turns over and they sort of go back to just running the business, which, quite frankly, I wouldn't be that opposed to. I think that they can easily double the size of this business over the next 3 years. The bottom line is you're looking at, over the next 3 months, probably while they work through this process, 50-ish% upside and maybe 15% downside.
Okay.
Great risk reward.
So the stock, even if a buyout doesn't happen, you think it's decent value?
Absolutely. I mean, like I said, it would probably trade a bit lower, and you'd have to sort of suffer through that for a little while the shareholder base turns over. But long term, I still love this company.
Your next idea, Adentra, used to be called Hardwoods Distribution.
That's right. They changed the name because there was a real common misconception that they were really levered to the price of wood, which wasn't the case. They actually deal with a lot more finished products. I watched this stock for years. I always thought it was a good business. Returns on capital were kind of mid-teens. It wasn't really enough to get me excited. And then in 21 and 20, they did massive acquisitions, which really kind of caused a step change in the business. The financial profile of the business completely changed. Growth went much higher. Valuation still really good. It's trading under 6 times forward earnings. And again, I think it's sold off maybe a bit on this whole housing slowdown, but as it shouldn't. So I think this one could trade quite nicely going forward.
So they distribute wood or architectural carved kind of fittings?
Think of things like parts for stairways, for example, more the types of products that would come in the later stages of a home, for example. About 40% is tied to new construction. About 40% of the business is also tied to renovations. So even if the housing market does slow, they'll get the kick on the renovations. And they also have a lot more products to sell now as a result of those acquisitions.
Right, but they're not a commodity lumber player, is
correct?
The thing.
Correct.
Okay. Although, I mean, this is another example of a company changing its name to something. What do they do? What's Adentra? Whereas before you knew what they did, Hardwoods Distribution.
True. If they were a hardwood distributor, then it would have been a name to keep. But I think that was something they really battled with investors is making them understand that that's not what the business is.
I see what you mean. Okay. And then Source Energy Services. What are they all about?
So this is a very small oilfield services company. They're actually one of the largest suppliers of frac sand in Western Canada. We don't do a lot in energy services, but this one really jumped out at me. And the reason for that is most of the business is long-term contracts that just rolled over this year. They've been replacing contracts at prices about 40% higher than the prices before. The stock trades at about 2 times EBITDA. The rest of the group's at 3 to 4 times. The real issue on this one, for those who actually know what it is, has been the debt. It was pretty highly levered, and now because they've had those higher prices, they're able to take the cash flow over the course of this next year, start paying down the debt. I think if we get that pay down or we get a re-rating on the multiple, the stock's probably a double. Here's the interesting thing. If we get a re-rating on the multiple and they pay down debt, this stock's probably a triple.
And that's interesting. And so the frac sand, well, that's obviously tied to any upsurge in drilling demand.
Yes, but if you look at what's happening, all the E&Ps are cashed up after last year, and they're looking to extend their capital programs this year. So Source would be a direct beneficiary of that.
That's interesting. Although we've heard a lot about the E&P companies being cautious about growing production. But they are getting a revenue bump, as you say, as the contracts roll over.
Yes, and keep in mind these E&Ps do have to, I mean, they haven't spent money in years. They do have to replace at some point. So from what I'm being told from the people I'm speaking to in Calgary, the environment's quite robust. And I think this will be the year for energy services. Last year was E&Ps. I think this year you're going to see energy services do quite well.